Good morning, everyone. Happy Tuesday. We have a really great episode from you that I have been waiting for a long time. We have Christopher Leonard. He is the author of The Lords of Easy Money, How the Federal Reserve Broke the American Economy. Chris has also written a bunch of interesting books, like about the meat industry, which has come into play around discussions on monopoly and inflation, and a book on the Kochland that Sagar and I really enjoyed. If you're an eagle-eyed listener, I referenced this during the episode, you will notice that it's actually on Sagar's bookshelf in the Breaking Point set. This episode is all about the Federal Reserve and Chris's contention that the Fed actually broke the American economy in the wake and aftermath of the financial crisis. As Sagar will talk about in a second, though, conversations about the Fed, which normally are totally to the side, are on everyone's mind in a bunch of different interesting contexts we'll get into. And this is just an important book for me because I know absolutely nothing about the Federal Reserve. And Chris has really written a book which is about making this desperately important and usually inaccessible topic actually accessible to people. Sagar, why was this relevant to you? Why are you interested in all the good stuff we're going to hit?
Yeah, I mean, there's huge Fed debates, obviously, right now, which are very important. Bitcoin, crypto, on the left as well, Elizabeth Warren. All of that is really just a cover for the fact that we're very dissatisfied with the economy. And Chris gives us his explanation for as to why he thinks that happened. And it was a result of the Fed itself. So I think that that's why it'll be useful to people. This is a controversial episode in terms of what he's saying, but I think it's a useful way in order to show you, or it's a useful thing to show you what some people are thinking about why exactly we are where we are. That's where I found it the best.
Yeah, and I appreciated his ability to balance the fact that he has a very aggressive point of view with wait, but how does the Fed work and why does it do what it does? So that was a really good introduction here. Okay, quick things before we get into the episode. Number one, we've got the tip function. Some people sent in tips yesterday. That's very appreciated and honestly pretty funny. Kind of feels nice when you only do it if you like an episode. It's not like huge amounts of cash. The idea here is it would be cool to have a little metric when people particularly captivated by something. Number two, we've got the Substack. Aaron Weiser, the very, very precocious high school student who started helping us out, wrote a summary of the books last week, but is also going out this week as well too. So we've got a lot of original content there. You could subscribe in the show notes. Thirdly, Bookshop. Chris's book is out. It's an excellent book. He's written 3 different books that are up everyone's alleys. So definitely go follow the link to purchase the book there, support the author, support an independent bookseller, and support the show. We literally moved tens of thousands worth of books last year. So it's exciting to keep that up. Finally, huge shout out to Lincoln Network for supporting our work and giving us the support we need to make this succeed. Let's get into the episode. Chris Leonard, welcome to the Realignment.
Thank you so much for having me.
Yeah, good to see you, Chris.
Good to see you too.
You have a really interesting body of work. We're discussing The Lords of Easy Money today, but you've also previously written Kochland, The Secret History of Koch Industries and Corporate Power in America, featured on the Breaking Point set for eagle-eyed listeners. And your other book, The Meat Racket, The Secret Takeover of America's Food Business. The first basic question is, what is the unifying idea, theory, approach that unifies this? Because this is over the past 5 or 6 years. Like what's the thing that ties all these disparate but seemingly related books together?
Yeah. Okay. First of all, big picture, I write about the economy. Okay. And I write about our economic system, but I do it from a certain kind of approach, I'd say. I mean, I think a reporter's job is to scrutinize the most powerful institutions, whether you're covering politics, whether you're covering private sector. Our job, I feel like, is to write about the institutions that have power, that shape our lives. And I think a reporter's job is to get into these places, to map out how they work, to understand who's in charge, how they make the decisions and the decisions they make. And so, in my books, I've written about the monopolies in our food system and the Meat Racket. I wrote about corporate power with Koch Industries. And now with the Federal Reserve, I'm writing about, the central bank. I think a real key concern in all these books, frankly, is growing income inequality in America. Why do we live in this system where we can have 10 years of economic growth, but most of the people in the middle who earn a living through paychecks are treading water while our economy is generating enormous wealth? It's just the wealth is being captured by a pretty small group of people, and I'm rather obsessed with that question and trying to figure out why are things this way. But again, like I feel like the fundamental job of a reporter is to describe how things work and to record an accurate history that's not easily available, that's not advertised, but that you really have to dig for. So a long answer to your question, but
no, of course, that's how we wanted to start. And the thing that's also coming through here too that I want to highlight is it seems like you're focused on institutions that are very opaque and difficult to understand. So there's the Supreme Court, there's Congress, but whether it's the meat industry, the Federal Reserve, and then the Koch, that's a whole other conversation. That's a huge whole thing there. But all three of those industries and institutions are not easily accessible or understandable. So I think that's an important way to frame the conversation we're actually going into today. But Sagar, I'll throw this to you next.
Yeah, I mean, I think the real thing is I have seen, and we'll get to this around politicization of the Fed, there is an increasing awareness that it's a thing, that monetary policy is something we should fight about, at least online. So let's start with the very basics for people. What does the Federal Reserve do? What is this charter by Congress? And then what does it look like in practice?
Absolutely. And I do want to hope we talk about this. There's been a very intentional effort on behalf of the Fed to remove their actions from the realm of politics and to describe it as if it's so complex and so hard to do that normal citizens, normal mortals could never understand what's going on. And I think that that's not just inaccurate, but it's very unhelpful because the politics of what the Fed does affects us all. And it's supremely important. So the Fed is our central bank. And what that means is the Fed was created in 1913 to do two key jobs. The first is to create and manage a currency. Before the Fed, there were actually thousands of currencies in the United States. You know, each bank would kind of issue its own currency, and it was the Wild West, and it was a financially disastrous era. And, you know, the U.S. had gone back and forth, first chartering and then dismantling central banks because we didn't want power to be that centralized. It kind of went against the American ideal of distributed power, at least how it was early on. But eventually, we realized you have to have a national currency. And that's what the Fed created. You know, the thing we call a dollar is actually a Federal Reserve note, if you look at the bottom of the bill. And so the Fed's job was to both create that and manage the currency. And then the second job the Fed had was to stop banking panics, to be the so-called lender of last resort. In the case of a banking panic, the Fed would be there to print money and loan it out to otherwise healthy banks to stop panics. So that's why we created the Fed. And what's interesting, I think, and what's important to our discussion is that over the last 20 years or so, the Fed has become increasingly powerful and had a larger and larger footprint. Its interventions have grown much larger and much deeper into the economy. And this really is kind of a big part of the story about the dysfunction and failure of American democratic institutions like Congress. We've relied on these non-democratic institutions to push our country forward, whether it's the Supreme Court to mediate our disputes, the military to handle foreign affairs, or in the case of economics, Congress has sort of sat on the sidelines, if you will, and it's left the job of stoking growth to the central bank. And I think one thing I'm trying to document in this book, as I write about the economic history of the last 10 years or so, is that the Fed is a supremely flawed tool to use to drive economic growth. Because at the end of the day, the Fed really only has one superpower, and that's the power to create money out of thin air. And the Fed has used this power to an unprecedented extent over the last 10 years. But it's really been destructive to our economy. It's dramatically widened the gap between rich and poor. It's created massive asset bubbles, economic instability, huge levels of debt. So anyway, that's what the Fed does.
Got it.
Yeah, and it's no expectation from us, by the way, for these to be short, clippy answers. That's part of the importance of this topic.
Thank God, man. I really appreciate that.
That's the point of the format. But this is very helpful because something I really appreciated in the book was your point that debates around the Fed don't really easily fall into left, right, center camps. You have AOC ticked off at Jerome Powell. Elizabeth Warren's ticked off, but Ron Paul also hates the Fed, and then Paul Singer is not happy with the Fed. So it's really mixed. So I want to understand, before we get a little deeper, what your central critique of the Fed is. You kind of gave it already, but so you're not objecting to the existence of a Federal Reserve, because some people do. So is your position that basically from 1913, 1914 up until the past 20, 30 years, you were happy with the Fed's performance and it was operating? So do you don't get what I'm getting at? Like what are the camps of Fed skepticism / opposition?
That's okay. I am sorry to laugh. The Fed could probably care less what I think about the Fed, obviously, right? And
well, we care.
Okay. So I really do think if you could have a functional, modern, industrialized capitalist society without a central bank, the U.S. would have done it. We were averse to the idea of a central bank. Again, until 1913, we didn't have one. I think a Fed is just necessary. Again, for the currency issue, you have to create an agreed upon currency that can hold value, and you can't really have capitalism without that. The Fed, of course, it's built from a very uneasy compromise of trying to create the centralized power, but make it accountable to democratic institutions, at least a little bit. But okay, so here's the central critique.
A quick interruption follow-up, though.
Yeah.
I don't hold this position, but the Bitcoiners in the audience are screaming at you. You were right until the year 2008. The Bitcoin exists now. You do not have to have a centralized banking system the way you're describing. What's your response to that critique?
Wow. Okay. This is a huge critique. The rise of crypto, the rise of Bitcoin, this idea that you have an alternative currency that's not, quote, like government money. And, I think that the advocates of Bitcoin and crypto also point to the fact that the expansion of Bitcoin is driven by formula or algorithm, not by a committee of 12 voting members like we have at the Fed that's driven by politics and all the rest of it in some way. I wish you didn't start, because this is the hardest question. Okay. And
because a quick thing to build on this, because it's like you said, it seems that to have a modern capitalist economy, you need the Fed. But they say this is the third way. We can have a modern capitalist technology that solves for a lot of the critiques that you are listing out here. They talk about quantitative easing as a bad policy, and it's something which you agree on. So that's why it has to come up now, because that's the immediate response.
And that's where we're gonna overlap. And I'm gonna get to my critique of the Fed in a minute, and I'm gonna describe why I think the Fed's policies over the last decade have really been destructive and not wise, and have put us in a terrible position where we are today. But I want to address your question. Okay, Bitcoin, I already talked about this earlier phase of American life in the early 1900s, the late 1850s. We had the so-called free money system. I mean, it was a wild west of currencies, and you could issue currency, and currencies rose and fell based on the sort of underlying health, for example, of the bank that issued them. And in my mind, I feel like we have been there. We have been there in a world of multitudinous and competing currencies. And, you've got Bitcoin, Dogecoin. I'm not familiar with all these crypto notes that are out there, but we've kind of been there in a sense back in the early 1900s, when you had currency from the Bank of Illinois versus currency from the Bank of Michigan kind of thing. And it was a period of financial instability that was unhealthy to the overall economy. And the question as to whether Bitcoin could truly step in and be kind of a universally accepted currency that could hold value is you got to admit, it's still very much an open question. I mean, we are super early in the days of Bitcoin, and a lot of the froth that we're seeing in this market, ironically enough, has been created by the Fed, in the sense that the Fed has created an enormous push into risky assets of any kind that investors think can garner a yield or profits, and Bitcoin has become one of those assets.
So this
And
is,
so,
yeah, go ahead.
yeah. No. And so, I mean, it's just another asset.
Well, so then I think that actually pairs. I want to take it in a different direction, but first pair that with your critique of the Fed, because this is the other part that I think is very key. You pointed out that Bitcoin and the rise of it itself, I've heard this critique before, is that the froth within the economy is actually pushing institutional money towards very, very risky investments. What would the alternative look like? And what is the bad policy of the Fed that's created this?
Yeah. And here's why we're sitting here. Here's why I wrote the book is, okay, in the first century of its existence, the Fed printed about $900 billion. And what I'm referring to specifically here is the new money that the Fed can create. As I said, it is the one institution on earth that can create new dollars out of thin air. That's the Fed's superpower. And that's why it's the most powerful institution in the world. And in the first 100 years of its existence, the Fed steadily increased the pool of what we call base money or high-powered money or original new money. It expanded that monetary base to about $900 billion. And on the graph, you see the money supply growing in a sort of a steady, gradual uptick as the economy grew. But then we have the crash of '08. And between 2008 and about 2014, the Fed prints $3.5 trillion. So that's 350 years worth of money creation in a few years. And the graph spikes. I mean, they break the bonds of history. They go way above. The graph of the balance sheet is just startling. And the reason they did that was in the beginning to be not just the lender of last resort to banks in a banking panic during the crash of 2008, but to be the lender of last resort to all of these shadow banks and insurance companies, the AIGs and the mega banks like Citigroup and JP Morgan. The Fed had to step in and stop this calamity in 2008 that, frankly, the Fed had also helped stoke because it had kept money so cheap for so long during the 2000s. The Fed stoked the housing bubble, which crashed. But then what's really key and what this book is really about is after the immediate crisis in '08 and '09, the US economy was digging out of a very deep hole. Everybody knew that we were going to have years of weak and anemic growth because we just had a banking crash and a financial crash built on debt. And crashes like that are terribly destructive and take years to get out of. And everybody at the Fed knew this, but there was political pressure on the Fed to do something. And the book starts on November 3rd, 2010, which not coincidentally is the day after the Tea Party took over the House of Representatives, the first midterm election of Barack Obama. The Tea Party comes in, effectively shuts down America's fiscal authorities, meaning the authorities that can tax and spend, meaning our democratically controlled institutions that could do something about these economic issues. They get shut down. And the Fed decides it is going to step into the breach. And it is going to be the primary engine of American economic growth. And Ben Bernanke leads this top policy committee at the Fed. The policy committee is called the Federal Open Markets Committee, or the FOMC. And he leads them on this very experimental plan to, first of all, pin interest rates at zero, which means the cost of money is nothing. The cost of an overnight loan is essentially free. That is radical. Overnight rates had brushed up against zero a few times in the past. What Bernanke did in the 2010s was pin that rate to zero for 7 years. A remarkable stretch of easy money policy. And at the same time, on November 3rd, 2010, Bernanke launched a plan called quantitative easing, which was to pump hundreds of billions of dollars into the Wall Street banking system. Okay, when the Fed creates money, it doesn't create money in the checking accounts of people like Chris Leonard or Sagar or Marshall. It creates money in the bank accounts of these 24 select institutions on Wall Street that are called primary dealers. It's JP Morgan, it's Wells Fargo, it's Goldman Sachs, all the usual suspects. They have special bank accounts at the Fed where the Fed can literally make money appear. I was on the trading floor at the New York Federal Reserve where they do this. It's kind of like a surprisingly modest room full of cubicles where a New York Fed trader calls up JP Morgan and says, hey, we'd love to buy $8 billion worth of treasury bills from you. JP Morgan says, fine. They give the treasury bills to the Fed. And then the Fed trader says, hey, look in your reserve account. Boom, $8 billion just appeared out of nowhere. That's how the Fed creates money through quantitative easing. And it created $600 billion in 2010, and then another $1.6 trillion in 2012. What it did was it flushed this money into the banking system. At the same time, it kept 0% interest rates in place. So there's nowhere to save the money. And the idea was that this would eventually stoke growth. It's like hyper trickle down economics. It's like, we'll give these trillions to JP Morgan and their clients like BlackRock, like Carlyle Group, the biggest hedge funds, the biggest private equity firms, in hopes that they will go out there and loan the money, and that the money will eventually be used to, hire people and build factories. What we saw over the last decade is that, in fact, this money did what many internal critics at the Fed warned it would do, which is it just stoked hyper financialization in our economy and overheated speculation on Wall Street. It created a epic historic boom in leveraged loans, corporate bonds, securitized corporate debt like collateralized loan obligations. It stoked up the price of stocks and these high-flying tech stocks like Tesla. It dramatically enriched the people who own assets. It dramatically increased the levels of debt in the United States, and it stoked asset prices to this wildly high level where it makes the economic system so fragile that we have these periodic financial crashes. So, the last decade, I call it the ZIRP era, or people on Wall Street call it the ZIRP era, which stands for 0% interest rate policy, or zero interest rate policy. And we've been living in a decade of ZIRP. And the ultimate result has just been a dramatic widening between the rich and poor, financial bubbles, and debt. And now we're at this position where we're going to have to pay the bill for all of this stuff eventually. So, that's my critique of the Fed, is that they have dramatically increased their writ, their footprint. And it's come at a damaging cost to the middle class, for sure.
Chris, let me step in and defend the Fed.
Yes.
At least from their view, which is, as you just said, the Tea Party basically shut down all fiscal abilities of Congress and the modern evolution of the Republican Party in 2010. They have a mandate such that they don't have to worry about electoral cycles. Why would they not do everything within their power in order to float the economy if Congress is to then abdicate its responsibility? Because from this view, what you're basically saying is that we should let Congress, or not even let Congress, is that we should allow a recession to be induced, a massive economic, catastrophe. And if they have the means to do something about it, at least within their means in the way that they're able to, why shouldn't they do that?
Yes. And wonderful counterpoint that, of course it's valid. It's like, what are you saying? That the Fed should have just sat on its hands and not tried? And my God, and, I'm a print journalist, which means I am barely clinging to the bottom rung of the middle class in America. I am not blind to the economic devastation of 2008 and 2009. I lived through it. I was an Associated Press reporter. They laid off 75% of my newsroom. Yeah. We were in real desperate straits in America in 2009. And you can actually draw a straight line from economic destruction like that to, terrible political instability and even war. Bernanke is a great student of the Great Depression, which fed directly into the horrible events of the 1930s. I won't belabor this point, but
no, could you, I know actually you should belabor this. You talk about Andrew.
All right, let me
book. Belabor it, please.
Well, let me belabor then. There's a straight line between the financial catastrophes of the 1920s and the rise of fascism in Germany, for example. And the reason I'm so reluctant to talk about this is it's such a darn third rail and cliche. But there is simply no question that the violence and social instability and war of the 1930s was directly related to the economic calamities of the late 1920s. The Depression was a horrifically dangerous moment in history. To put out my full political stripes, I feel like we were lucky that FDR was president in 1932 when he was elected. If I got that year wrong, forgive me. But he was elected in the 30s and pushed America in one direction. In Germany, the crash was calamitous. There were definitely other issues going on there as well. But they had the very famous hyperinflation of the Weimar Republic, which led to the rise of Nazism. And look, to bring it back, the point is you don't play around with depressions. And
one quick thing,
go ahead,
Chris, because it's important. You hit this in the book. Can you talk about Andrew Mellon? So he was
yes,
because this is very important, because Andrew Mellon, in response to this 20s period, is very explicitly believed that there's a morality to not responding. Could you speak to that? Because I think it's really important that people understand that so many of the post-2008 problems, it's not just about conspiracies, there's a lot of very terrible choices that have to be made. Governing politics about balancing act. And I think it's useful to have an example of the 20s of when different choices were made.
Well, absolutely. Let me go there, but let me put a pin in this. Sagar, I really want to respond to your question because I criticize what the Fed did and I'm going to own it. And I want to explain to you how I got there. But okay, so Marshall, let's talk about Andrew Mellon. Remarkable character, remarkable guy. Andrew Mellon was this industrialist who became Secretary of the Treasury under Herbert Hoover during the real crash times, the late 1920s. And that would sort of be like if Charles Koch was Treasury Secretary under Trump. He was this super rich guy, very conservative, Andrew Mellon, and was running a huge chunk of the government's economic program in the late 20s. And you could kind of crystallize the theory of Mellonism in his most famous quote that he's going to be remembered for forever, which is that when the markets start to crash in the late 1920s, President Herbert Hoover, who was actually like a pretty intelligent technocratic kind of guy, was struggling to figure out how to respond. And Mellon reportedly, as Hoover recalled it later, comes into the office and says, look, you've got to let this crash go because it's a necessary correction to excess. And Marshall, as you pointed out, Mellon made this kind of moral argument that, we were living beyond our means, the bill is coming due. And he said, liquidate the farmers, liquidate the stocks, liquidate it, let this crash burn through and get out the underbrush. Well, that is, I think, appropriately remembered as exactly the wrong approach to the problem, because this sort of liquidation and downturn can become a self-fulfilling cycle that then builds its own damage and creates a downward spiral of deflation and depression, because that's exactly what started to happen. And I guess one quick way to kind of summarize it is that when you let things get so bad, let's not forget that 70% of our economy is driven by consumer spending. Mm-hmm. The real job creators in America are lower and middle class people who spend money. Those are the job creators. That's what we depend on. And when you let those people get pushed out of work to the point that unemployment is at 10%, 15%, spending falls, demand falls, prices fall, and the economy can fall into a hole that is theoretically impossible to get out of. I mean, FDR, to his credit, tried a lot of wild experiments, and not many of them worked until demand from World War II stoked our economy again. Depressions are a deep hole. So that's Mellonism. That's this sort of laissez-faire, step back and let the crash occur. And I think it's wrong-headed. And I want to say the reason I talk about Mellon in the book is because, the main character in the beginning of this book is this guy at the Fed who voted against quantitative easing and said, hey, we should not be doing this and we should not be pegging interest rates to zero. And this guy was a regional bank president from Kansas City named Thomas Honig. And he's kind of remembered, I say inaccurately, he's remembered as a Mellonist or as an ultra hawk or as a cold-hearted person who said, the Fed should not step in and help. We need to be we need to follow these rectitude and this sort of moral high principle of tight money. Well, that recounting is inaccurate. That is not, in fact, what this guy, Thomas Honig, was arguing when he really staked his career and kind of lost his reputation in certain circles by voting against 0% interest in quantitative easing. And Sagar, if I could circle back to this question of like, well, what the heck? You think the Fed should have just sat on the sidelines, or, should we have entered a depression? Okay. First of all, the book starts in 2010, and we were out of the crisis at that point. I don't want to underplay how bad things were. Growth was weak. Job creation was anemic. Unemployment was still high. But we had just exited the real crisis and the economy was just starting to grow again. And it was into this weak and fragile recovery that Bernanke decides to print trillions of dollars and keep interest rates pegged at zero. So that's a different thing from saying we're going to respond to the crisis. We're going to douse the fire as it erupts. This is saying that in the dawn of the recovery, we are going to step in and drive economic growth through printing money. That's the key distinction that happened here. And let me say, let me get some water.
Yeah, of course.
Of course.
It's very dry here in the winter months. I'm in Kansas. So when I started this book, I really kind of wanted to write like a Moneyball about quantitative easing. I wanted to write an explainer that people could use to understand the Fed and how it works mechanically, how it influences our lives, and how different the last decade has been from the rest of history in terms of the money printing. It's spectacularly different. But, the original subtitle of the book was How Quantitative Easing Changed the World. The final subtitle of the book is How the Fed Broke the American Economy. Mm-hmm. And, I'm very cognizant of how confrontational that subhead is. I had my shift while reporting this book when I reported on the largest round of quantitative easing in 2012, known as QE3 or QE Infinity. When I went back and read through the transcripts of the actual internal debates that they had, and when I looked at the internal forecasts, the Fed's own forecasts of what was going to happen if they did QE, which were like spectacularly wrong, I came to the conclusion that this policy was reckless and not wise and building up long-term risks for very short-term gains. And I think more importantly, that the Fed knew at the time that this policy was going to pump up stock prices. It was going to superheat Wall Street with the hope that it would eventually, with the hope that it would eventually increase employment by maybe, 1 million jobs or a few 100,000 jobs, which is a lot for those people, but is relatively small in the big picture. The Fed was going to create these massive financial risks and give a subsidy to some of the riskiest financial companies in America, like the private equity buyout firms, all to simply look like it was doing something, to get credit for stepping into the breach. And I think the policy was wrong-headed. We should not be driving our economy by pumping money into the biggest of the big banks, the too big to fail banks that are now larger and less able to fail. That's wrong policy, is the conclusion I came to.
So I want to go back to something you said earlier, because it gets at contradictions, the wrong way to put it this way. So this isn't a gotcha, But you referenced the fact that in 2010 on November 3rd, part of what drove Bernanke and the Fed to begin quantitative easing was political pressure. And earlier in the episode, you were pointing out we don't have democratic input over these policies to the degree to which would be hypothetically desirable. Yet it seems as if that addition of political pressure led to the policy that you're concerned about. So what's I guess the basic theme that from my perspective on this episode as a non-expert on the topic is, what's the balancing act of there's two questions here. So why did political pressure work in that example when you are largely telling a story of an institution that by its very design is very resistant to political pressure? And then two, why should we think that political pressure or even more democratic input would be good when the very policy that this book is really about attacking, not in a bad faith way, but just pushing back against, seems to have come from a situation where political actors thinking of their reelections or a harm that happened to them in the system were pushing it towards some type of big action?
Yes. And let me say, as an investigative reporter, I love gotcha questions. And I think I should face them as somebody putting out a book that says how the Fed broke the economy. I mean, you've really got to be able to explain that. And the contradiction you bring up is a really important one. It's such a good point. Okay. So I've said Bernanke and the Fed acted under political pressure to do quantitative easing in 2010, and then even more so in 2012, even more so with that QE infinity round.
Two very important events are happening in the political system in 2010 and 2012.
Yeah, that's exactly right. Let us not forget. I mean, this literally was right before the election between Barack Obama and Mitt Romney when the Fed passed this QE infinity. Okay. But at the same time, a really important thing to understand about the Fed is that it has been built to be insulated from democratic pressures. The Fed was built to be insulated from voters. The Fed is run by an administrative committee in Washington, D.C., okay? And like all things at the Fed, it's kind of this hyper-complex governing system. You've got what we'll call a board of directors, okay? The Fed calls them a board of governors. They sit in the office in Washington, D.C. There's 7 of them. And these governors are led by the pretty powerful chairman or chairwoman in the case of Janet Yellen. And the chairman oversees the board, okay? The board of governors. But then, the Fed is actually comprised of 12 banks. It's such an interesting American thing in that they built the central bank to actually be a network of 12 banks, kind of like a federated system like the United States. And each of the 12 banks has a president. And so all these things come together under this committee, which I mentioned, the FOMC, the Federal Open Markets Committee. This is the policy-making committee of the Fed. It's the super powerful committee. When you see the photos of, the Fed got together today and raised interest rates, it's these people at this huge long table. That's the FOMC. The Board of Governors is appointed by the president and approved by the Senate. But that's sort of about the last place that a democratic institution touches decision-making at the Fed. Once the governors are appointed for a multi-year term, they're not accountable to voters at all. And the regional bank presidents are never accountable to voters. And this committee I mentioned has 12 voting members at all times. But what's interesting is that a majority is always made up of the Board of Governors. So really, the Board of Governors controls everything. Okay, big picture, the central idea here is that the money printing power is not only so large, but there is such a powerful force of seduction to misuse it. Mm-hmm. Okay, every government, when it finds itself in a pinch, has to make hard decisions between cutting spending or raising taxes. The money printing press can be expanded or shrunk or run more quickly or run more slowly based on this sort of committee decisions made by the Fed. And the founders of the Fed, which was Congress, they said, hey, we can't give this power to politicians because they'll run the printing press right before election just to get elected again. And that creates this downward spiral of inflation, which we see in other countries. Zimbabwe or Venezuela, Argentina, right now, Turkey. I think Turkey's actually a really great example right now. They overprint money for short-term gains, and then it creates an inflationary spiral. And we said the Fed needs to sort of be above the fray. I think there's actually quite a bit of logic in that. And it's the sort of same logic that drove the creation of a lot of institutions that are, independent agencies in Washington, D.C., the Federal Trade Commission, the Environmental Protection Agency. These are supposed to be seen as sort of like neutral forces outside of the political realm. That's key to understanding the Fed. And another key trend is that power has concentrated more and more and more and more each decade into that chairman's office. I mentioned the board of 12 people. Really, it's highly chairman driven, as the book points out. It's pretty remarkable how much power the chairman has. So how could I possibly say that this committee is driven by political decisions? One really interesting history of the Fed is this book by this economist named Alan Meltzer, who does like a 3,000-page deep dive into the history of the Fed from 1913 to about 1978 or so. A big chunk of history that includes the great inflation of the 1970s. And the reason I'm talking about this is I think Meltzer pointed out really well why we went so catastrophically wrong with the great inflation of the 1970s. And it was that in the 60s, the people who sat on the FOMC, while they didn't have to face voters, they read newspapers every day. I mean, they're not immune to reality or political pressure. So political pressure plays a role. And it's evident and indisputable that in 2012, Ben Bernanke, the chairman of the Fed, felt a lot of political pressure to do something. Mm-hmm. It's amazing. He talks about it just in black and white in the transcripts all the time. His primary argument against the critics of these money printing policies was that, hey, we got to do something. Like there's a risk to doing nothing. And I think it was this necessity to appear as if you're doing something. And that's where the political pressure comes into play. But while there might be that pressure to act on the Fed, they are not accountable to voters. And there's very, very little way for voters to actually have any democratic control over what the Fed does.
And
so,
yeah. Another follow-up here, because you're getting at something that's very difficult here, which is, I would like to understand your articulation of what a more accessible Fed would look like. You started off the episode by pointing out that, they basically almost act as if this is alchemy and it's ununderstandable and only an elect few could basically do this, this, and that. And obviously that isn't desirable. But on the other hand, the story of American governance, the reason why the Supreme Court and the reason why these institutions like the Fed have taken more control over policy, it's not even that Congress has just said, because I hate when people say it's, oh, Congress just says, go deal with it. I think it's more that these institutions actually just cannot actually come to a consensus themselves. Congress actually could not, given partisanship, given specific incentives of individual members. Jeff Flake himself speaks about how he voted against the 2008 bailout basically for shits and giggles, and how it was one of the biggest mistakes of his career because he just didn't understand what was going on there. So how do you really draw a balancing line between a very clear trend this century where it's very clear that opaque, inaccessible, centralized institutions don't seem to have as much legitimacy as they used to, and that's a huge problem for the political system. On the other hand, it's unclear what the alternative would be. So I don't expect like a perfect answer, but I'm curious how you think about the push-pull there.
Yeah, huge question. And let me instantly dodge it. Okay. I'm kidding. Like I'll answer your question, but also let me say, I again, to come back as a reporter, I have really tried to write the history from November 3rd, 2010 to 2021, including the bailouts after the COVID pandemic, and just write about what happened and what the effect was in a real way. For example, I'll talk about Fed speak in a second, but the Fed talks about these programs of large-scale asset purchases being tapered to let yields on 10-year treasuries change. It makes no sense to people.
Yeah, I don't understand what you just said, like straight up.
Exactly. Yeah, well, you're not supposed to, and you're not supposed to understand it. And I think one of my real advantages just being a reporter is I get to talk to people on Wall Street, inside hedge funds, in the investment world, who aren't high-minded theoreticians. They're traders who understand the reality of what the Fed is doing. And I can talk about not just the consequences in the markets, but the third order effects, the second order effects of this stuff. I write a lot about an industrial company in the Midwest whose senior management team just engages in a gorge of stock buybacks under this regime of easy money while they're shedding jobs and shifting production to Mexico. Okay, so that's the reality I'm trying to convey. But to really get back to your question, I see your question as two fundamental things. First of all, how would you structure things differently? Am I saying we should have more democratic control of the Fed? Am I saying that the leadership structure should be different? Is that basically the first part of your question?
Yeah, because look, like my editorializing here is I think that a clear story of the 2010s is that democratic control is poisonous. Honestly, it's
yes.
Because of part. It doesn't have to be this way, but the clear, and this is a thing we cover on the show, the Realignment, a huge problem we have right now is that every topic ever is inherently politicized. So I'm very sure within 2 seconds you would have some senator talking about woke. Actually, no, climate change. This has already happened with Jerome Powe and the climate change conversation. Like the speed at which American politics in the 2020s could take an issue and turn it into a polarizing cultural war issue it's actually incredible. So I'm curious, like, to your response to that framework, basically.
And I think it's a incredibly important point, because one thing I point to all the time is the New Deal. And the reaction of our federal government to the crash of the 1920s and the Depression, in terms of banking and the banking system, instantly the Roosevelt administration stepped in, shut down the banks, nationalized the banks that had been doing the riskiest speculation. They passed the Glass-Steagall Act, which is segregated banking into speculative investment banking and then commercial banking, which would handle just normal people's checking deposits. Huge reform. But the key point here is there was political consensus. Mm-hmm. You had this really broad political support for this idea that the government had a role to shape markets. And there was broad support for, Roosevelt. There wasn't just support for what they were doing. There was pressure to do it through labor unions and all the rest of it. Today, it is absolutely fair to say there's no consensus out there. There is, first of all, unfortunately, just rampant disengagement from politics as reality. To the degree most people, I think, engage with politics, it is with very emotional and provocative issues promoted by cable news. It's this fight against blue versus red. But when you get down to actual politics, it's very, very boring technical business of administering power in the United States. There's very little engagement with most of the machine as it actually functions day to day. That's a huge part of the problem in our politics today. And then for the people who are paying attention, as you accurately pointed out, zero consensus. In fact, very, very, very bitter dispute. So why in the world would we want democratic control of the power to manage our currency and print money? How could that ever possibly work?
And actually, can I just, I love what you're saying, so I'm just getting excited. So I just want to say this real quick. You started the episode off by saying one of the most important issues you're focused on through this frame is the lens of income inequality. And this something I'm really proud of is this is a very bipartisan show. I'm like, half the audience doesn't agree with that. Half the audience would basically say, actually, government's role doesn't have anything to do with income inequality. Insert quasi-conservative, self-libertarian belief on that question. So I liked how you highlighted that there was a real consensus and mandate in the 30s around addressing the challenge you're putting here. When if you were to describe a broken America, a question we have on the sheet here that we didn't get to is like, define how America is broken. It's interesting that we could ask 100 different people that question on the economic issues. They would give you probably 20 to 30 different answers there. So that makes it hard to find the consensus you're describing. So I just want to highlight that because it's very helpful.
Couldn't agree more. And the politics of money is absolutely wild and upside down in the sense that back in the early 1900s, when we created the Fed, the politics of money was a retail issue. People really cared about the currency of the United States. When the progressive populist William Jennings Bryan was running for president, he probably said the most famous quote ever about monetary policy when he said, "You shall not crucify mankind upon a cross of gold." That was like about quantitative easing in its way at the time. He was saying we can't have tight money policy. The birth of the Fed changed that. First, in a fundamental way, it took the politics of money away from the fiscal or like the democratically controlled sphere and put it in this technocratic institution of the central bank. But then we saw that trend supercharged under Alan Greenspan. And there's a whole chapter in the book called Fed Speak, which was this sort of, people used to think it was kind of hilarious, but now I think we can look back and see how damaging it was that Greenspan created this theory that when a Fed chairperson gets up in front of Congress, they simply can't be comprehensible. They have to speak in such complex, inner spiraling, opaque language. I quote a paragraph of it in the book, which I could just stare at that paragraph forever. It intentionally makes no sense. And the idea here was that we need to keep Americans off the playing field. And again, make it sound like this committee that runs money politics in America, the FOMC, these people are so brilliant and they are operating at such an Olympian level that they're basically just solving math equations. They're not even making policy decisions. Well, that is exactly wrong. And if there's one thing,
the book is like you're running a nuclear reactor. That's even that's even the more apt metaphor there.
Exactly. And, later in the book, I talk about this bailout. I call it the invisible bailout. Pre-COVID, in late 2019, the Fed was trying to do what the Fed's trying to do now, which is to withdraw its stimulus money from Wall Street. And we had a financial panic in September 2019 that did not get much attention. It was a panic in these overnight loan markets that are the lifeblood of Wall Street called the repo markets. Mm-hmm. And the Fed had to step in September 2019, before there was a case of COVID. The Fed had to step in and print $400 billion just to keep Wall Street functioning. And the Fed describes it in clinical, mechanistic language as if they were just fixing the plumbing. But what I show is that it wasn't just plumbing. The Fed was bailing out a bunch of hedge funds that had made really risky bets in the treasury markets. And so that's what was driving the panic, or at least that was one of the critical factors that drove the panic. And when the Fed stepped in and printed that $400 billion and brought down those repo market prices, they were bailing out a bunch of hedge funds that had taken wildly risky bets. So this is just one tiny example of talking about how the Fed's decisions are policy decisions. They create winners and losers. And I think that citizens really need to be informed about that and need to understand the contours of what the Fed is doing and how it is creating winners and losers. And without question, how it is stoking income inequality in America.
I think the last thing I want to add here, Chris, is, and we referenced it earlier, is I think some of this is coming back with crypto, with Bitcoin, there's enormous discussion of this online, given that we're probably in the most controversial Fed period today than we have been since 2010 with the return of quantitative easing. I unironically sit next to normies on planes who tell me about the M2 money supply and all that. And I'm like, well, this is interesting, right? Like this is not something that you necessarily would hear in the past. So looking forward, what are the debates that we're going to be having? Is it a summary of what you're saying here? Is it crypto? Where are some possible trajectories for where things go?
Okay. And quickly, over the last decade, all these policies, these easy money policies, have forced the quantitative easing cash out into the investment sphere. That's why there's such a boom in corporate junk debt, in tech stocks, and in crypto. That's what I was trying to say earlier. A lot of this money seeking a home is going into crypto and driving up the price, which is going to create the kind of instability in the price of Bitcoin that we see right now. Okay, but you asked me about, what are the debates over the next year? Let's kind of forget about the high-minded debate about the Fed's role or what it's doing. We are in a tactical crisis right now with the Fed, and I don't say that lightly. The last decade, by design, has pumped up asset prices in the stock market, in the corporate bond market. The corporate bond market is like the housing bubble of the 2000s. You can go back and look at the press coverage during the crash of 2020. It was understood that these structures of corporate debt, like collateralized loan obligations, were starting to collapse. The Fed stopped that collapse by not only printing $3 trillion in a few months during 2020, but also by directly subsidizing the corporate debt market, directly buying corporate junk debt for the first time in its history. Okay, the Fed has been steadily and patiently pumping up asset prices for years in the stock market. It's called asset price inflation. And the Fed has accepted asset price inflation as a cost of doing business, that it'll drive these prices up. And if there's a crash, it'll bail out the bankers behind it. The one reason the Fed was able to do this is we never had price inflation. Okay, you've got asset inflation in the stock market. Price inflation is when you see an increase in the rise of bread, gasoline, automobiles, and consumable goods like that. We haven't really had hot price inflation for decades. And quite unfortunately, now we do. And it is forcing the Fed to do something the Fed has avoided for over 10 years, which is to tighten the money supply. Because unfortunately, the only way you can stop price inflation, almost certainly the only way you can stop price inflation, is by raising interest rates and withdrawing this easy money that the Fed's been pumping in through quantitative easing. Back in the 60s and 70s, we struggled with inflation. The federal government tried all kinds of price controls, wage controls. They couldn't lance the bubble until the Fed hiked interest rates, which was economically disastrous. I am not in any way trying to advocate, like, nobody wants to see what happened in the early 80s happen today. But right now, the Fed is in a vice. It cannot keep interest rates pegged at zero and keep permanently pumping billions into Wall Street, as it has been doing since COVID. It can't do that if inflation is still running at 7%, which is where it was at the most recent reading. We'll get a new reading next week. But so if the Fed starts to tighten the money supply, if it starts to raise interest rates, if it starts to pull back this cash, there's every reason to expect we're going to see what has happened time and time again since 2013, which is that asset prices are going to rationally adjust downward. In a world where short-term interest rates are at 2.5% or 3%, it doesn't make sense for hedge funds to be invested in these risky corporate junk debt, in Tesla options and shares of Tesla that are, gained more value in 1 month than the total value of like Ford and General Motors combined. Investors are going to withdraw from those risk assets, as they repeatedly have done, bring down prices, and potentially create what Jay Powell called a large and dynamic event in markets, which is economists talk for a crash. And so for the next year, we're going to be involved in this very choppy situation where the Fed is being forced to tighten money and face the consequences of what that's going to look like in the global markets. And I talk about it where these bubbles have inflated in global markets, emerging market debt. Companies like Evergrande in China saw tons of cash flow into them. Stock market, corporate debt markets. There's going to be a real choppy road ahead.
And Chris, we'll wrap with this quick question. As you said, this is super opaque. There's lots of Fed speak out there. What is your recommendation for someone who's listening and has been introduced to these topics for the first time? Like, where should they go next? Like, obviously, it's not going to be that 3,000-page history of 1913 to the 1970s. So, like, what are your immediate, like, where's the next place someone should go beyond, obviously, purchasing the Lords of Easy Money? Like, where should people go if they want to delve deeper into this?
Gosh, that's such a good question. I have been a little bit frustrated that so much of the mainstream press coverage around the Fed seems to be written for bond traders. And the central driving question is, what's the Fed about to do? And how's it going to affect stocks? Right. These questions matter for bond traders, not for citizens. So I'm a little bit stymied at your question, and it's a great question. I'm a big fan of newspapers. I read the New York Times, the Wall Street Journal, the Washington Post on a day-to-day basis. They do outstanding coverage of kind of the X's and O's of what the Fed is doing. Bloomberg does a fantastic job as well, I think. One reason I wrote this book is I didn't feel like there was coverage of the Fed's actions over the last decade from the standpoint of like the public interest, the political economy perspective. I'm really kind of grasping for, and I'm self-conscious
too hard because that's kind of the answer. This is the answer. Like that's basically the point. If something isn't coming to mind, then that's actually revealing and telling in of itself of the problem that people are facing.
And I'm self-conscious because it's such a thirsty, buy my book kind of thing. And I don't mean it to be like that at all. But there's a great book written about the Fed back in, I think, the 80s called Secrets of the Temple by William Greider.
Somewhere there.
I'm looking back at my research books. Oh, Sebastian Mallaby.
He's coming on the show at the end of the month, by the way. So he wrote the Man Who Knew, which is about Alan Greenspan. Sebastian Mallaby, for listeners, he has a book about venture capital. He also wrote a book about hedge funds. So that's a quick preview of a conversation we're excited for. Sorry, go on. Had to do my advertisement.
No. His venture capital book, I'm going to buy the day it comes out. And his book is technically about Greenspan, but it's actually a beautiful and brilliant history of the modern Fed during the Greenspan era. It's about much more than just Greenspan. Magisterial book. I love it. Now that you say it, okay, Adam Tooze.
Yep. Yes, we had him on the show. Yeah, he's good. Right.
Super good. And
this would be Crashed.
I just remembered. What about Lords of Finance? That was a pretty good book. I read that a while back.
Absolutely. Yeah. And it's, as you know, it's about the 30s, right? And it's about that era. And I think that's really important background and is a fantastic book. Crashed, also a fantastic book. You really got to care to read that book. Yeah, man, I see it on your bookshelf.
I stole this from PBS, so I haven't even read this. But the point, audience, this is a lot. This is how many pages is it? This is 600 pages. It's an investment.
Yeah. But Shutdown, which I've got over there, Shutdown, his new book about the COVID crash. Wonderful, beautiful book. I think really captures the calamity of COVID overall. So those books are a great place to start. I am a little bit jaundiced about all the Federal Reserve as rescue hero books. There was a whole mini genre of how the Fed saved the world in 2008. A lot of it is deserved, but I think a lot of it obscures deeper points. And certainly, I have a different perspective of what happened from 2010 until today.
Really well said. Well, Chris, thank you for joining us on the Realignment. The book is out today. This is coming out on Tuesday, January 11th. I'm happy, by the way, that you weren't caught in the Omicron book delay debacle. For people who are wondering why we're going to have some difficulty booking shows with both of us together in the next 2 weeks, everyone pushed their books back 1 week, except for your book. Thank God, so we could air this. Because I'm telling you, Chris, what happened, maybe your publisher had this happen, but I've gotten like 10 emails, not even kidding, saying, hey, could you push this interview back a week? Can you release this interview for the 1st of February, mid-15th? You got to smile and you got to grin and be like, of course.
Yeah, totally.
But yours is coming out on the original date. I am so happy. Thank you so much.
Thanks, Chris.
You bet. It was a jump ball there for a minute. Simon & Schuster worked hard to get it out. So thank you, gentlemen. I really appreciate it.
You're welcome. Thank you, sir.
Thanks, Chris.
Thank you.